Volume Profiling, Module 1, The Apprenticeship. Welcome to Module 1. What does the structure look like for the module? It's very simple. It's broken down into 5 key elements that you'll find across all 4 parts of Module 1. The first element is theoretical principles. Every part will begin with theoretical principles. Once we've completed those theoretical principles, we will then have practical examples. Now, across Module 1, there are in total 19 theoretical principles. At the end of each part, we are going to have learning videos and a summary video. This is to ensure that you understand the principles that we've taught throughout each part. In total, there'll be 10 of these learning videos and summary videos. We'll then have a profile replay. The profile replay is a replay of any given day that's backdated, whereby we can stop, start and pause any given day as the profile is being distributed across various prices. This allows us to view patterns in real time and ensure we're picking up on the various characteristics that you find whilst a distribution is occurring on any given day. We'll then have a concept checker at the end of each part. Again, the concept checker is to ensure that you've understood all the principles taught throughout each part. And last but not least, at the end of every part, there will be a playbook entry. This playbook will be provided to you and you will then have to complete it before moving on to the next section. In total, there will be 9 playbook entries throughout Module 1. Good luck! Hi guys, so again, welcome to the Volume Profiling course, Module 1. This is what the index is going to look like for Module 1. As you can see, it comprises of 4 parts. Part 1, we're going to start off and talk about why 95% of traders lose money. Why professional traders use volume profiling. What is volume profiling? The future of volume profiling as a tool. The definition of edge. Steps for volume profiling success. And objective versus subjective analysis. In part 2, we're going to move on and talk about key market participants, time frame participants, and the trading auction process. Part 3, then, we will talk about the volume profile as a trading tool, volume profile metrics, and then the argument between traditional value area versus volume value areas. In part 4, we're going to move on to volume profiling anomalies, the process of trading with volume profiling, the basic volume profile trade setup, choosing your volume profile software provider, and then setting up profiles using trading technology charts, and then the rules to succeed in the trading arena. As you can see, it's quite a big overview of volume profiling, but once you complete all 4 parts, you'll have a very good understanding of the basic concept of volume profiling. By the end of this module, you'll be able to do the following. Understand why professional traders use volume profiling as their preferred choice of trading tool. You'll be able to define between subjective and objective market analysis. Develop your own trading edge by following a step-by-step process that I will provide you with. You'll be able to identify various time frame participants, but more importantly, understand when and why those time frame participants enter the market. Interpret the key principles that define the auction process. Be able to identify and apply the key metrics of the volume profile. Recognize and utilize volume profile anomalies. Develop a process of trading with volume profile as your preferred tool. And lastly, answer the questions at the end of each part and be able to update your own trading playbook. In total, Module 1 should take you roughly 10.5 hours. Now what I've done is I've broken down each part into its various elements and given you a guided amount of allocated time. If you look, Part 1 should take you 2 hours and 45 minutes. This is broken down into an hour for principles, 45 minutes for concept checker and summary, and 1 hour for the playbook entry. Part 2 should take you 2 hours and 15 minutes, 45 minutes for principles, 30 minutes for summary concept checker, and 1 hour for playbook entry. Part 3 should take you 2 hours and 15 minutes. Principles 45 minutes, Summary and Concept Checker 30 minutes, and the Playbook Entry 1 hour. And Part 4, Principles 40 and Part 4 should take you 3 hours and 15 minutes. Principles 45 minutes, the Summary and Concept Checker 30 minutes, and the Playbook Entry 2 hours. Most important, guys, don't rush through each section. Spend a lot of time particularly on your playbook, as this will reinforce the principles you've learned. More importantly, this playbook will go through you for the rest of your trading career as you continue to develop and evolve. Hi guys, Part 1. Why 95% of traders lose money? Now, this is one of the first discussions I would have with any young trader or any of the guys I would mentor. And the reason I go over this first is I almost want to get rid of a lot of these hidden, fallacies, within the trading environment. I think a lot of people seem to think, or there's this illusion that trading's easy and you can make a lot of money quick, and that it's an amazingly fun job. And so for me, this topic is very important to discuss early on, so that I can kind of just bring you back to reality. Now, there's a couple of key characteristics that define the 95% of people that fail. So, in essence, if we knew why 95% of people fail, so long as we don't do that, so long as we avoid those pitfalls, surely by that definition we should then be part of the 5% that succeed. So what are these characteristics? Well, first and foremost is overtrading. Now, what I'm going to say is going to sound a little bit counterintuitive. However, in the beginning of your career, when you start trading, when you're learning about the markets, trying to understand the markets, in essence, you need to overtrade a little bit. Why? Because the quicker you make mistakes, the more often you make mistakes, the quicker you're going to be able to learn from those mistakes. So, as a trader in the beginning, be aggressive, be assertive, right? But do this on a demo account. Do this on an account that is not real money. Once you've made those mistakes, once you enter the live market with real money, we no longer overtrade. What we do is we take our edge, we take our strategy and implement it. We don't force new strategies in the market. We don't force ourselves in the market. So the first characteristic is overtrading. The second characteristic is trading without a defined edge. Now, a lot of traders out there think they have an edge. They think that they bought because they read it on Twitter, or they heard that there's this new tool out there. However, that's not a defined edge. A defined edge is where you look at a market, you have a logical process, and you execute based on that process. That is an edge, and that is what you require to succeed. Now, a lot of traders, they have no defined edge because they tend to trade a little bit more subjectively versus objectively, and we're going to talk about this a little later on. Emotional decision making. Now, I know a lot of you would have experienced this before. This is one of the key pitfalls for most new traders. They get into a bad trade, they get into a sticky position, they're unsure what to do, they don't cut the position, they hold the position, and the next thing they do a lot more damage. Now, it's not the financial damage that does the most damage, it's the psychological damage. In other words, the scar that is developed as a result of a bad decision. So, emotional decision making is one of the reasons why traders never fully recover and eventually fail. Ego. We need not speak about this. If you're a trader, to an extent, you probably need to have a little bit of an ego. You need to have a little bit of surety and confidence in your ability. However, this needs to be sort of managed. It's okay to be confident, but not be overconfident. The minute you step out of the realm of what you're used to doing, the minute you start trading more size than you used to, or you start slacking and thinking you know it all and stop learning, that is when the market catches up with you, and that is when the market takes money away from you. Then, not enough time spent on interpretation. I see this all the time, guys. So many traders out there, they tend to look at the markets and just trade the markets, but they never actually go back and look at the trades they did, look at the execution, look at how they did things, how they managed certain trades. It's only through managing or at least spending time on your interpretation and understanding of the markets are you going to fully develop yourself and, more importantly, become successful. They fight trends. 95% of people end up fighting trends. Now, it's okay to be a counter trend. It's okay to fade a trend. But what is not okay to do is when you've identified strength in a market or momentum in a market, it's not okay to fade. So remember, it's fine to go against the trend, but do it when you understand that you are against the trend so that you can manage yourself accordingly. Take big losses. Again, as day traders, as professional traders, our number one job is money management. So if we're not managing our money correctly, if we're losing 10-20% of our portfolio in any single day, all right, we are never going to succeed in the long term, because it's very unlikely or very unusual for a trader to make 20% return on his portfolio in one day. So remember, if you're not going to make 20% in one day, you shouldn't be losing 20% in one day. Again, a very important one, and a lot of you would hear this and you can almost liken to it, but complete dependence on tools, right? There's a lot of you out there that seem to think that, having these tools is what gives you the edge. It isn't, guys. The tools are merely reference points, okay? A tool is merely telling you or adding value to the information that you're already receiving. Remember, markets are forward pricing. Markets are always, looking to reprice themselves based on new information coming in. So a tool that's telling you, for instance, a moving average, that's telling you where the price was on average over the last 20 minutes or 20 time frames, that is lagging information. The market's fully priced that. So just remember, tools are reference points and they're not there to make important decisions on. The search for certainty. Very important. A lot of traders are always looking for exactness in trading. They're looking for complete certainty. The markets don't offer you certainty. The markets don't offer you guaranteed. They offer you probability. Just knowing this notion, guys, just stepping away from the idea that, that this exactness, that will almost open you up a little bit to trading a lot better. So just remember, the markets only offer probabilities, not certainties. Then, market profiling is a holistic, objective, factual, context-based understanding of market activity. What does that mean? It means the market doesn't care what you think. The market doesn't care whether you're right or wrong. The market doesn't care how much money you got. It doesn't matter how intelligent you are or how smart or tall or wonderful you are. The market is just purely price going up and down. If you remember this, guys, you're going to keep this job a lot more simple than most people make it. Number one reason why a lot of people fail is they overcomplicate the trading process. Just remember, price can only go up and down. It's us that makes that up and down a lot more difficult. Keep it simple. To highlight, to be successful, you have to do what 95% of people don't or do all the time. Sorry, to be successful, you have to do what 95% of people don't do. If you can do that, you will be a successful trader. So why do professional traders use volume profiling? First and foremost, it's a tool for consistent pattern recognition. What do I mean by that? Well, at the end of each day, I'm able to go through my volume profiles and pick up on very specific patterns because of the way volume profile depicts price, volume, and time. So by using volume profiles on a day-to-day basis, I can not only find these patterns, but I can also see how these patterns evolve and then develop edge using those patterns. Volume profiling is a tool for interpretation. What do we mean by that? Well, instead of having the traditional tools of Fibonacci's and moving averages and trend lines that don't give us forward-looking information, we can use the volume profiles that can give us principle-based interpretation. Meaning, we're able to make forward-looking decisions using volume profiles. Volume profiles allow us to remain very objective as opposed to subjective. Why? Well, a volume profile is exact information. It's fact-based. It's happened. It's occurred. It's not opinionated. It's merely fact-based. So we can make fact-based decisions instead of subjective-based opinions. Volume profiling is principles rather than hard, fast rules. Again, this allows us to have forward-looking trade strategies as opposed to relying on indicators that are lagging. Volume profiling, again, it allows us to move away from what we like to think of as obvious application of trade setups. What do I mean by that? In other words, there's a lot of obvious trades in the market, trades that, everyone looks at a support level from a long time ago, and it's very, very obvious. Now, obvious trades, algorithms are able to duplicate those trades. All right. If a trade's very obvious, there's less likelihood it's going to work because it's very obvious. So volume profiling, because it's principle based, is not so obvious. All right. There's a lot of interpretation required, which means you have edge. And then volume profiling allows for exact risk management. What do we mean by that? Well, if we enter a trade based on a volume profile strategy, we know exactly where that strategy is no longer valid. Therefore, we can effectively manage our money and ensure we're not taking very, very big losses. And last but not least, the reason professional traders use volume profiling is simply because every professional uses it. So it becomes a self-fulfilling prophecy. If all the traders around the world are using these volume profiles or using this tool in order to depict price, time, and volume, then surely the market will respond to certain or a lot of these strategies. What is volume profiling? Well, in simple, volume profiling is price, time, and volume depicted in one graphic representation. As you can see on the chart on the right, we've got time, volume, and price all in one chart. Volume profiling's core idea is simple. All financial markets are measurable by time, price, and volume. Not all prices are equal as in traditional trading, as volume is transacted differently at each price. This change in volume, or this volume that's transacted at each price, therefore means that not all opportunities are equal. And this is key in managing probabilities of risk. Market-generated information is pure, unbiased information that comes directly from the market. So structuring and interpreting this information is an excellent way to get a truly objective opinion about what's actually driving the market as it's based on real order flow. Volume profiling is forward-looking. So it's not looking back on past data or past information, it's forward-looking. This means that we can make strong decisions based on what future prices will do, as opposed to strong decisions based on what past prices have done. Volume profiling is about identifying opportunities where the risk is considerably less than the potential reward. If you can find these opportunities using volume profile, you have found yourself strong strategy. Let's look at an example now of what a volume profile looks like. Firstly, as you can see the first chart, we've got traditional candlesticks. Now, as you can see, that price is depicted on the right. Each candle is a time-based candle, and at the bottom we can see the volume. Now, if we put this into a volume profile, you can see it's the exact same information, it's just depicted in a volume profile chart. It's this volume profile chart that will allow us to easily identify patterns and remain objective. So what does the future of volume profiling look like? Well, in order to understand the future, we need to look at what various tools have done in the past. Now, you go back a couple of years and traditional tools like moving averages, Fibonacci retracements, trend lines, these used to work particularly well because everyone used to use them. However, with the advent of algorithms, nowadays these sorts of trade strategies are very heavily utilized by algorithms, and they're very good in the execution in the sense that they've now crowded out most of the retail trades. And that's why a lot of the time these trades like the 50% Fibonacci and these trend lines, they don't work as well as they used to. However, with volume profiling, because it's not an exact tool where there's exact execution methodology, the algorithms cannot utilize the strategies we're going to show you that effectively and that easily. And for that reason, volume profiling has got a long future ahead of it. Then, volume profiling focuses very heavily on money management. Now, because of this very reason, this is why a lot of people will continue to use it, because it's an exact approach where you know where you're getting in, you know where you're getting out, you know where your risk lies. Because of that reason, volume profiling will remain a very sort of chosen market tool. Then, edge is self-created with volume profiling as you assign strategy to a set precondition. So what this is telling us is that because we are being very exact with our strategies using volume profiling, we can therefore develop edge. So basically, because we're developing real edge as a result of using volume profiling, we wouldn't want to use any other tool so long as that edge remained. More importantly, because you can continue to develop various strategies using volume profiling, you will continue to develop not just one edge, but various edges. Then, success is not as dependent on its users as it relies on the response of institutional, influential participants compared to Fibonacci. So what we're trying to say here is that back in the day, a lot of trading tools used to be successful simply because everyone used them. For instance, the Fibonacci. Back in the day, the 61.8 was very, very popular simply because everyone used to trade the retracement of that, key retracement. And because of that, it became a self-fulfilling prophecy that that trade worked. Nowadays, however, it doesn't work so well. However, with volume profiling, it's not as dependent on the users that use it. Why? Because volume profiling in essence is forward-looking information. So as the information is being fed into the market, it drags in various longer-term time frame participants. And it's this that creates some of the very, very big moves we see in the markets. Therefore, because it's forward-looking, it implies that the volume profiling will continue to progress as a tool and be utilized into the future. Then, volume profiling is not a trading system, nor is it predictive. Note, it's not exact, it's not buy here, sell here. It's merely a principle-based approach where we're looking to engage in various strategies based on forward-looking information. Volume profiling allows you to observe structure as the market is unfolding that structure, and that enables accurate interpretation of which time frame is in control of market movement. It therefore uncovers vital information and clues that help unravel strength and weakness in the market momentum. So in other words, guys, because volume profiling is giving us so much important vital information, it will remain a preferred tool so long as it continues to provide us with this information. Last but not least, volume profiling takes what is ultimately very complex in terms of a lot of movement, a lot of different tools, a lot of information, and it all puts it into one simplified chart. For that very reason alone, the fact that it can take a complex set of data and put it into a very simplified chart, that's going to allow us, not just today, but into the future, to develop highly effective strategies using very simplified information. The definition of edge. What is edge? Edge can be a number of things. For me, edge is very simple. It's an advantage. It's a unique advantage. Now, the important thing to understand about edge, guys, is that edge doesn't last forever. Okay? The reason it doesn't last forever is because as time goes by, more and more people that are observing loads of different strategies will eventually pick up on your unique edge. So how do you keep this edge? Well, it's very simple. You have to continue to develop this edge. And you have to continue to develop other edges. By doing this, you will ensure that you always have a unique advantage over the market. So, how do we effectively develop our own edge? For me, there's three basic things you need to do. 1, you need to continuously recognize patterns. We can do this utilizing volume profiling. By constantly looking at the markets through a volume profile, we'll be able to not only just look at our own edges or strategies, but we'll be able to develop unique new strategies. Then, repetitive deliberate practice. It's very simple. Every time you have a strategy, you need to go away and keep going over and over that strategy. Keep practicing that strategy in your head, on paper, in the markets. You need to constantly be upgrading that strategy and developing various skills around that strategy to ensure that you always master that strategy as well as you can. Remember, guys, in this day and age with the advent of algorithms, every tick counts. Every increment counts. So you have to be perfect. If you're less than perfect, you're leaving money on the table. Last, manage and perfect the process. This is what caps off edge. If you can have a perfect process in whatever you're executing, whatever strategy, it doesn't matter. If you can perfect that process, you will be successful. You will have a long-lasting edge. Remember, trading is all about controlling the controllables. You cannot control the market. You cannot dictate which way the market goes, but you can control your own process. You do this and you will have a unique advantage.
So typically I get in about 6:30 in the morning. I look over the Asian markets, see the moves, the S&P, the T-notes, JGBs, and then look at the overnight news. If there's anything significant, I'll note that down. And then I'll look at the opening call for my market, which is the Bund, Euro stocks, and basically the whole German curve before I go into my technical scenarios and jotting them down before the markets open at 7 AM. And then generally I'll watch the markets for the first hour just to get a feel for how they're optioning, and then my core hours are probably from 8 to about 10:30. For me personally, it's very important. It gets me in the right frame of mind at the beginning of the day because I find if it's disjointed and unorganised, then I waste a lot of energy trying to get into the rhythm and focus. And it ensures that I get done what I need to get done to access my edge. And then also it's a point of reference, I think, when you look back over your day and your end of day debrief. I think deliberate practice is everything for the discretionary trader because it's a skill set that you have to develop. It's more of an art than a science, I believe, and you have to work on the individual skills that make up your edge as a trader, whether it be order flow, technical patterns, different execution techniques for different conditions, and the only way to cement those skill sets over time is through deliberate practice. I think when you're starting out, it's important to be open-minded. As the beginning trader, I think if they come in with a fixed mindset or a rigid approach, they might not find out what works for them personally, because everyone's different, and also it takes a lot of time, so patience is very important. One day they might find a pattern that works and then it might not reoccur for another 6 months, so it takes a long time to cultivate an edge that will last a long time.
So let's see now how one of our professional traders has developed his edge and ensures that he constantly upgrades his process to ensure that he maintains his advantage over others. So what are the steps for profiling success? Well, first and foremost, we need to recognize a pattern using volume profiling. Now, not to worry, I will show you numerous patterns within this profiling course, as well as when you join the streaming service. Every single day we will show you unique strategies that you can backtest and have a look at and develop yourself. So, once you have found a recognizable pattern, you need to go and do what I like to call a Harry Hindsight backtest. What this is, it's very simple. You go and find that similar pattern or that pattern, and you go and find 5 other examples in the market. Okay, you then take these examples and you lay out the results of those examples. Okay, and what I mean by that is you physically find out how many ticks it would cost you to take on that trade versus how many ticks or prices you can make on that trade. So do a little bit of a risk reward, very basic risk reward analysis. Now, the reason we do it this way around and we do that first is because we can very easily identify if there is a strong enough pattern. Right? A lot of patterns, don't always necessarily give us the best risk-reward metrics. So we want to know early enough, is this strategy actually worth pursuing? Then, once we've done the visual Harry hindsight backtest, we then need to go and do a practical replay backtest. What do I mean by that? We physically need to view the data as it's received live into the market. Now, most of you would normally do that on a day-to-day trading live markets. However, in this day and age with the technology available, you can actually get the data and replay that data in a live market type scenario. So with that information, what we do is we physically see how this strategy played out. We physically see how the market shows us that information in real time. Now, there's two reasons we do this. First and foremost, we want to be able to live the strategy whilst it's occurring. Now, the reason is because a lot of us look at a market at the end of the day and we go and we say, well, that was a relatively straightforward buy or sell. The strategy was there. All I had to do was execute. But what we cannot practice just looking at a chart is the feelings and emotions of living through every second or minute or couple of minutes. So it's so important that we can go back and feel that trade out again as it occurred in real time, but not risk capital in doing so. The second reason that we want the practical replay is that we can pick up on various observations that the market is showing us in real time that can then confirm the trade strategy, or more importantly tell us that actually the trade strategy is not occurring as it should. What do I mean by that? For instance, if we take a basic trade strategy like a very aggressive buying tail. Now, we know based on this strategy that we don't particularly want to see aggressive selling at any point on a pullback. If we do see that aggressive selling, it's giving us a very early clue that maybe the strategy isn't going to work out as well as we would have liked it to work out. So by being able to relive the experience, we're able to pick up on very early clues as to when a trade strategy is working well and when it's not working as well. And it's this that will give our unique trade strategy a very strong advantage or an edge. Once we've done the practical replay, we then set our conditions and parameters for early observation and potential execution. So it's very simple. You have a trade strategy, you've backtested it. You now go and put in place the parameters. Okay. Remember, a unique edge or a trading strategy has exactness to it. The process is exact. There's no ifs and buts, there's no maybes, there's very little subjectivity. It's all objective. Alright, so because of these parameters, this will mean that we can allow ourselves to just trade the trade and put in place the execution that is required. So that is our fourth step. Then our fifth step is we need to create various trading rules, as well as money management rules and risk management rules. Again, we do this before we execute. We don't want to be in a trade in the live markets and start thinking about where is my stop, how much am I risking on this, where is the trade wrong, what should I be identifying whilst being in this trade. All of this is done before we execute the trade in the market. Remember what I said to you in the previous slide when we spoke about edge. Right? You need to have a perfected process. If you perfect the process, you will succeed in that trade strategy. It's the fact that we're not fully prepared for that trade setup, the fact that we're not entirely sure of what our risk is, that is what creates the confusion and ultimately leads to poor execution. Then, last but not least, we want to test with small size. So once you've found a strategy that works well, you've created all the parameters, you set in place the rules, you know exactly how the trade plays out, you then want to start testing it, putting real money in the market. Now again, when you're putting real money in the market as opposed to simulated money, you're going to create a whole different experience because of the emotional aspect. Don't forget, however, always lean on the fact that you've got a strong edge or a strong process. If you do this, it will allow you to become less emotional and focus more on the objective information that's coming from the market. Once you've found a successful strategy, don't forget, leverage up. Don't be afraid to leverage, guys. Too many traders in general are afraid of this thing called leverage. If you have got a real genuine edge, the path to success is via leverage. Leverage is what can make, dreams come true. Then, last but not least, always constantly assess and upgrade and evolve your patterns. What does that mean? It means that the trade doesn't end when you make profit. The trade doesn't end when you switch off your trading machine at the end of the day. The trade only ends when you've taken that strategy, broken it down for the umpteenth time, and you've gone over it time and time and time again. That's when the trade ends. Okay? Keep upgrading those trade strategies, because by upgrading them, you're upgrading your edge, you're enhancing your edge, and you're ensuring that you're ahead of those that are trying to develop the same edge as you. This is by far one of the most important principles you're going to learn in part 1. Objective versus subjective analysis. So what is the difference between the two? Well, subjective or subjectivity is influenced, or feelings or opinions, or intuitive or instinctive. It's this opinion we have about something having to occur because we feel it should. Now, where do these subjective ideas come from? Well, first and foremost, they come from very big fundamentals, whether that's data that moves the markets, whether that's companies producing new products, or whether that's a new big thing on a new big trend in the market. All these sorts of fundamentals give us these ideas, these opinions, or this instinct that something should go up or down. Subjectivity also comes from CNBC and Bloomberg and analysts. Why? Because, well, we see these high-profile individuals on the TV and writing articles in the newspapers, and we think, well, because they're experts, they must be right. And all of a sudden, we put ourselves in these subjective ideas, or in the subjective mindset that something should occur because someone high-profile said it. Then, most important, subjective is because of opinions. The opinions of your peers, of other traders, of what other people think, of people on Twitter. Right? All these things together put us into a subjective mindset, or an opinionated mindset. Now, what's the counter to that? What's the opposite to that? It's objective. Okay? Objective is not influenced. It's factual based. It's unbiased. It's neutral. Fair-minded, open-minded, impersonal, and unemotional. As we can see, it's the complete opposite of subjective. It's fact-based. It's exact. There's no idea or opinion about it. So, where does objectivity come from? Well, we can get objectivity from volume market profiling. We can get objectivity from price action. In other words, what we're physically seeing prices do. We can get objectivity from various trading strategies. All right? If we have a trading strategy where we have exact execution, there's no ifs and buts. There's A and B. So, the question you have to ask yourself is very simple. Are you being objective? In every single trade you take, in every single strategy you develop, are you being objective? Every time you click on that mouse, you should be able to say, I'm being objective in this approach, in this process. And is your trading strategy exact? If it isn't exact, guys, you do not have an edge. You might have a good idea, of course, but you do not have an edge. In other words, in the long run, that trading strategy is going to cause you to lose more money than you're going to make. Now, as we can see from the funny little picture, whilst it's simple, it's highly effective. As we can see, the wonderful boyfriend and girlfriend are sitting down, eating a piece of cake. Now, we can see that, the boy is looking at the cake thinking, oh, my girlfriend can't cook or bake at all. And he's thinking, well, her food's not very good and this cake's going to be terrible. So we can see that he's got an opinion, a preconceived idea of what it would be like. However, if we compare that to the number of round dough balls on the plate, we can see that factually there are 4 of them. It's objective, it's exact, it's not opinionated, it's an exact thing. And that's the major difference between subjective and objective. Subjective is opinionated. Objective is fact-based. Let's now further develop this idea of objectivity versus subjectivity. Remember what we said. Objective is fact-based. Are you being objective in your trade, or are you being subjective in your trade? What we're going to do now is we're going to go through a couple of examples, and I see this all the time. That's why I've put these specific examples. What I want you to do as we go through each example is I want you to put your idea, before I answer it for you, I want you to tell me whether it's being objective or subjective. And hopefully by the end of the slide, you'll get a better understanding as to why it's so important to remain first and foremost objective with a little bit of subjectivity. So, our first example, alright, the US labor data non-farm payrolls. It's the most highly anticipated data piece out of the US that comes out on the first Friday of every single month. Now, here's the example. So on any Friday, choosing Friday, the non-farm payrolls rises 320,000, but it was only expected to rise 180,000. So straight away, there's a huge piece of information in the market and prices need to reprice. So, first and foremost, is this objective or subjective? The US dollar should rally 1 to 2% given how strong the data is. Okay? Yes, it's subjective. Why? We don't know how far the US dollar should rally. Nobody knows how far the US dollar should rally. Alright? It could go up, it could go down. Nobody knows. To say that it should go 1 to 2%, given how strong the data is very subjective. It's very opinionated. Our next example. The US dollar could initially see buyers enter given stronger than expected data. Now this is a far more objective statement. Why? Because as we can see, the US dollar should see buyers. In other words, we are basing our statement on fact. In other words, we know if we get a much stronger US non-farm payrolls, factually we should see buyers. Okay, we might not, but factually we should see. That means we are remaining objective. Then our third example, the US dollar could see buyers enter with a high probability for a trend-like move. However, if buyers are unable to sustain a strong bid, this implies strong sellers are using liquidity to execute large orders. Now this is a mix. It's a tricky one. It's a bit of objectivity with a bit of subjectivity. But note how we're being objective first and foremost with a little bit of subjectivity. So what we're saying is the dollar could see buyers enter with a high probability for a trend-like move. That's our objective statement. Our subjective statement is that if the buyers cannot sustain a bid, it means that sellers are utilizing the liquidity to execute large orders. Now this bit of subjectivity comes from experience in trading the markets over non-farm payrolls. Important to note, guys, we are first and foremost always objective, and then a little bit of subjective. It's important to have a mix of both, but always rely on objectivity to make your trading decisions. Why? Because it will protect you in the long run, whereas your opinion will only cause you damage. Now, our second example. As you can see, the E-mini S&P 500 has gapped lower because of an aggressive overnight sell-off after the unexpected Brexit decision. So a lot of you would have seen this example. A lot of you would have come the next day and said, well, the UK's left, it was never expected, this is the worst thing that's ever happened. All we got to do all day is sell, 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 sell. A lot of you would have been dragged into a subjective idea there. Why? Well, because CNBC, Bloomberg, Financial Times, Wall Street Journal, all of these publications were telling us that is what should happen. Therefore, straight away, we all put our sell-side hats on for the equity markets. And we said, well, our opinion is the same as the media, therefore it must be right. Was that the case? Let's have a look. So, our first statement, the market can bounce because it's oversold. Can it bounce? Should it bounce? Okay, the market can do anything, guys. Right? Is that an objective or a subjective statement? It's very much subjective. It's opinionated. The market can bounce because it's oversold. How do you know what's oversold? Okay, these are the kind of questions you want to be asking yourself. Then, the next example. there is a high probability for a gap and continuation. Okay, again, now with experience and our strategy, we know that because the markets have gapped, we know that there's a high probability for continuation. So the fact that we're stating a fact-based statement means we are being objective. All right, we've seen the gap, the market has showed us the gap, and we are therefore remaining objective with the information that we received from the market. Our last example, if the market trades to my key support, I will buy it for a bounce. Okay, here again, we've got a little bit of a mix. We've got an objective statement as well as a subjective statement. Why? Because if the market trades to my key support, all right, what is key support? It's subjective, right? One man's key support is another man's key resistance. Don't forget that. So the fact that we're saying if it trades to my level means we are being subjective. However, because we are trading it or I'm buying it for a bounce, I'm employing an exact strategy, I'm remaining objective. By allowing myself a specific strategy with a subjective opinion, I can have an objective outcome, if that makes sense. Okay, so just ensure there's nothing wrong with having a subjective opinion or an idea about what should occur. Just make sure you've got an objective strategy in place to keep the balance. Then our next example. WTI oil has sold off on oversupply fundamentals, but Goldman Sachs thinks there is a possible correction likely. Okay, so if I see a buying tail on the 60-minute candlestick, I will buy with Goldman's comment. Is this being objective or subjective? Well, note here, okay, we said if I see a buying tail on the 60-minute candle, I'll buy with Goldman's comment. I'm not buying because of Goldman's comment. I'm buying because of a buying tail. In other words, I'm allowing the market to show me an objective outcome before I execute a subjective idea. I'm being objective. Then, our next example. If I see a low volume extension of the current day's low, I'm going to fade it with a $1 stop given how important Goldman Sachs' opinion is. Again, it's a trick. Of course, we're leaning on Goldman Sachs' comment. However, we are utilizing an objective trading strategy to execute on. And because of that, we are remaining objective, even though we are using somewhat a subjective statement from Goldman Sachs. Then our last example. I will get long and look to average myself into the position, given I agree it is definitely oversold after moving 15% in 3 days. Okay? Again, this is clearly subjective. Why? What is oversold? Okay, yes, some people use overbought and oversold tools, but those tools are based on so many different varying parameters. One man's oversold might be one man's opportunity to continue to sell. Don't forget that. Lagging information isn't necessarily objective information. Forward-looking information, however, is objective information. And it's with volume profiling that we can ensure all the information we have at our disposal is forward-looking as opposed to lagging. Those are some of the examples from subjective versus objective information that we receive from the marketplace. Let's now continue this discussion of objective and subjective market analysis. Now, the example I'm going to take you through now is one that sort of baffled and bamboozled the financial markets for many, many years. It's called the Alan Greenspan conundrum. Now, the reason I want to show you this particular example is because we tend to think that it's only retail traders that are sometimes too subjective in their approach and analysis. In this example, we're going to see, and I'm going to show you, how not just the new traders, but the financial gurus and the professionals made huge errors in their judgment about what the rates market should have done. More importantly, a lot of people lost a lot of money, and these are sometimes the professionals we rely on. What's the moral of the story? Remain objective as often as possible. Leave the subjectivity for people with deep pockets. You as a trader need to remain objective because that will help you develop an edge in the long run. So what was the Alan Greenspan conundrum about? Well, it's very simple. In 2005, former chairman of the Federal Reserve failed to understand why fixed income didn't respond as expected to the multiple rate hikes he had initiated in the previous year. In theory, higher interest rates would imply higher long-term rates. More importantly, expectations for future rate rises would imply that the longer end of the curve should also rise. And this is what baffled not just Mr. Greenspan, but most market participants. So if we take a look at this basic yield chart, what we can see is on the x-axis we can see the maturity or length of time, and on the y-axis we can see yields or yield opportunity. Now, what we should in theory see on this curve is as rates rise, in other words, as yields go higher and higher, as we go further along the maturity curve, we should see higher and higher rates. Why? Because one, we have rate expectations in the future going up. So this would imply we should have a steepening of the curve or a higher end of the curve. What actually occurred, and what we'll see a little bit later on, is that the curve actually went the opposite direction. And that was the conundrum. So, just a nice little summary, a brief summary of how to interpret the difference between objectivity and subjectivity. And this is something I keep very close to me, and I write it down quite often. It's simple. If there are more buyers than sellers, prices will rise. That's fact-based objectivity. How those prices rise is a matter of subjective opinion. Write that down somewhere, because that will ensure that you are always remaining as objective as possible with a little bit of subjective analysis. So, many institutions lost money. Why? Very simple. They became too subjective and forgot to impose their objective analysis. If you do this, you are going to land in trouble. Yes, of course, time and time again, you may get away with being very subjective. But remember, this is a long-term game. Get it right from the start. Be objective in your approach, objective in your analysis, objective in your execution. Subjectivity to develop your strategies and develop your edge. So let's take a look at this conundrum and see why people were so baffled. What we've got here is a chart dating back to 1986. And as we can see, we've had 1, 2, 3, 4 rate hike cycles since 1986. Now the first major hiking cycle from 86 all the way up to 89, we can see the solid dark blue line. That's effectively the Fed funds futures rate. That's the US Fed hiking cycle. Now, as that goes up, we can see a very strong correlation with the US 10-year Treasury yields, which is the luminous light green color there. Now, we can see that in the first and second and third hike cycles, every time the Fed initiated a hiking cycle, we could see a very strong positive correlation with the US 10-year Treasury yields. As interest rates rose, we saw 10-year Treasury yields rise. Now the conundrum is what happened in 2004. We can see a very aggressive, gradual 25 basis point rate hike cycle starting in June 2004. However, this time around, we can see that the US Treasury 10-year did not quite go as expected based on the previous 3 hiking cycles. Now just imagine this hiking cycle lasted almost 2 years. Imagine the frustration and the pain and the losses that a lot of institutions and traders would have taken as a result of relying too much on the past. What's the moral of the story? Remain objective, right? Yes, it's good to have a subjective idea. Yes, it's good to look into the past for guidance. But if something is not occurring as it should, if the objective facts are not being given to us by the marketplace, we need to ensure that we're not committing too much capital and energy to that trade. So had we remained objective in this example in 2004, right? Yes, we might have lost a little bit of money, but we wouldn't have lost 2 years of our lives trying to fight something that wasn't happening, trying to preempt something that was not happening. So just remember, history doesn't always repeat itself. Just because something happens in one instance doesn't mean it will repeat itself. That's the example. Now, what I want to lead you to think about is the Fed started hiking in December 2015. They initiated the first 25 basis point hike. So, based on history, a lot of people are saying, well, the yield curve should begin to rise. Now, as of the date of doing this course, yield curves haven't started to rise. In fact, yields have continued to move lower. So again, we're seeing a very similar instance as we did back in 2004 when the rate hike cycle was going up. Yields don't necessarily have to go higher as well. Keep that in the back of your mind as the Fed continues their hiking cycle. Now I want to show you what happens when you allow subjectivity to be the most or the priority instead of objectivity. What we're going to look at again is this 2004 rate hike cycle. First to understand, rates fell. In other words, long-end rates actually fell in 2004, even with 5 consecutive rate hikes. So just imagine, for the year of 2004, when the Fed had hiked 5 times in a row, imagine you were on this trade or on the wrong side of this trade for almost 5 or 6 months. How would that have felt? How would it have felt to be offside on an idea that you thought was absolutely flawless based on history? How would that have felt? Then, rates began to finally rise in Q1 of 2005. So after all that pain and torture, finally rates began to rise. However, how far did they rise? Well, long-end rates continued high in 2005, but only rose above the highs made at the start of the hiking cycle in Q4 2005. In other words, had you taken on this trade when the Fed embarked on their hiking cycle, you wouldn't have even got back to the point where you entered the market. Imagine how painful that would have been. Let's look at it on the chart. As you can see on the chart, we have the blue line which depicts the 17 consecutive rate hikes or 25 basis point rate hikes from the Federal Reserve starting in 2004. The orange line is the US 5-year Treasury bond yields. The red line is the US Treasury 10-year yields. Now, as we can see, from the start of the hiking cycle, had you initiated this trade for higher yields, you would have almost instantly gone offside. You would have been losing money for the first 6 months of this trade. You would have been losing money. How would that have felt? How would you have explained that? Imagine you're a hedge fund. How would you explain that to your investors that you're losing more and more money because based on history, yields should go up? How would that have felt? Can you see now why it's so important that we remain objective even when we have very strong subjective ideologies or ideas based on history? Now, the purpose of me showing you this is I want you guys to understand that the principle is that it's good to have a little bit of subjective ideas. It's good to have intuition and experience based on the past. But first and foremost, always rely on objectivity. This market clearly showed us that yields were wanting to move lower, even when, in theory, they should have been moving higher. Therefore, we shouldn't have been holding on to this trade. We should have accepted that something was not right. The market was giving us fact-based information that yields weren't going to rise, even though subjectively they should have. Let's take a look now at the 2015 rate hike cycle. The Fed initiated the first hike in December 2015, historic. Now, remember what we said, in theory, when rates rise or interest rates are pushed up higher by the Federal Reserve, we should see longer-term yields rise as well, in theory. Note the Greenspan conundrum. The last time we saw this, it didn't occur according to theory. In fact, it went the opposite direction. So what do you think's happened this time around when the Fed initiated the first hike in 2015? Well, first and foremost, 10-year Treasury yields, as depicted in the red line, traded at 2.06 the day the Federal Reserve signaled a rate hike in October 2015. Remember, they signaled in October, they hiked in December. Currently, as of October 2016, we can see yields are at 1.6%, almost one full calendar year later. So what does this tell us? Well, it tells us that yes, in theory, history does give us good ideas. It does give us a sense of subjectivity. However, had we relied on that subjectivity again in this instance, just like the Greenspan conundrum, we would have lost money again. Note how the market sold off quite aggressively this year, or in 2016, ever since the Federal Reserve started hiking rates. So, are you confused? Well, you shouldn't be, because so long as you remain objective in your approach, in your analysis, it's okay to take these trades on. If you took the trade on for higher yields, it's okay. It's a good trade. However, just ensure that you have objectivity to protect you in the event that the markets don't react or respond in the way they should do. So let's summarize subjective versus objective analysis. It's very simple. It's all about a balancing act. It's all about ensuring that subjective intuition plus objective market-generated facts equals successful analysis. Make sure you have a balance of the two. It's important to develop opinion, intuition, and understanding. These are the kind of things that give us edge, that give us trading strategy. But just ensure that you always remain objective, even when you have almost certain opinion, when you feel so confident about something. Just make sure that you're not forgetting your objective understanding of the market. Because it's this objectivity that's going to protect you from many, many pitfalls that a lot of traders make, which costs them very dearly. We've reached the end of part 1. Let's summarize all the key principles we've dealt with thus far. Firstly, we spoke about the 95% of traders and why they happen to fail. So what we're going to do, what you would typically do is draw 2 columns. In the one column you'd have 95% of people, and the other column you would have 5% of people. Now what you want to do is you want to go highlight, not just today and what we've dealt with, but over time, all the characteristics that define those who succeed and those who don't succeed. So for example, 95% of traders that fail tend to take big losses. 95% of traders that tend to fail also tend to come into the markets every day with some form of a bias. 95% of traders who fail tend to have no edge. Then what we do on the other side is we try and highlight all the key characteristics that define traders that succeed in the industry. Firstly, they tend to have very strong routine. They tend to follow a very stringent set of rules. They tend to have a very process-orientated approach. And they have a very, very strong edge. Now, this is not an exhaustive list. The point of this is that you as a trader, as you go on in your career, as you spend time in the markets, you will pick up very quickly what are the things that cost you money and other traders. When you identify them, add them to the list of 95% of traders that fail. Equally, when you find certain characteristics amongst your peers or even within yourself that allow you to succeed as a trader, make sure you highlight them in the reasons for success. That way, over time, you'll very quickly pick up on what characteristics are required to succeed and what are required or what characteristics lead traders to failing. That was the first principle we dealt with. Then we moved on and we started to talk about the advantages of volume profiling. Now, I'm going to quickly highlight those advantages just so you can remember them. The first was we said that with volume profiling we can turn what is known as a very complex environment into a simple environment. We then also said that we can use volume profiling for very quick early pattern recognition observation. Okay, so by using volume profiling, we can very quickly not just notice patterns, but we can also then examine patterns over time. We also said that volume profiling is a forward-looking tool. So we noted that things like Fibonacci's and trend lines and support and resistance all tend to be lagging type tools, whereas volume profiling tends to be a forward-looking tool. We then also said that with volume profiling, we can have exact money management. And given that money management is so key in not just day trading, but all forms of trading, being able to manage your risk and your money management is highly crucial and one of the main advantages of volume profiling. And then we also said that it's not easy to automate all the volume profiling strategies, and as a result it means that volume profiling in the long run is a tool that can give you a sustainable edge going forward. So that was some of the advantages that we spoke about when talking about volume profiling. We then moved on to talk about what is volume profiling, what is the basic essence of volume profiling, and I think the best way to explain this is to illustrate it. The volume profile is nothing more than a distribution or a manner in which we can represent the three key variables, being price, being time, and being volume. And we noted that we'll have a set of prices on this side. We'll have a set of time being this entire distribution, and we'll have volume being dispersed over all these prices. And we said that in essence is the basic distribution. Now, if we were to just convert the just take a basic candlestick chart and convert it into some form of a distribution. Let's say, for instance, we had a traditional day where we saw candles going up, 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 and up. The distribution will show that. We'll just have lots of different distributions. So we would have effectively the distribution, and we'll see that over time the market will distribute, 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 and wherever the market spends the most amount of time, so let's say the candlesticks came back and then went up and came back, where the market spends the most amount of time is where the distribution will become a little bit fatter. So there's nothing, using volume profiling is no different to candlesticks, it's just a different representation of the same information. All right, then we moved on and we started to talk about the future of volume profiling. Where is volume profiling going in the future? And why it's important that, if you learn the tool today, it will, stand you in good stead going forward into the future. And some of those advantages or some of the key characteristics we identified for the future of volume profiling was obviously one, because of the automation. In other words, volume profiling will teach you a set of principles, and algorithms cannot easily automate principles. And it's for that reason that the tool going into the future will survive. It won't be, if you look at a lot of modern day Fibonacci's and things that are very mathematical and exact, they're easily sort of automated. So because volume profiling is not as easily automated, it won't easily be, it will last into the future. We then also said that it's a strong forward-looking tool, and because of that, traders will tend to adopt this tool, going forward. And as a result, it becomes a self-fulfilling prophecy that volume profiling will continue to exist and succeed as a form of developing edge and pattern recognition. So those were some of the characteristics defined about the future of volume profiling. We then moved on and we spoke about edge, and we spent a bit of time on this and how crucial it is to develop edge as a trader in order to succeed in this job. And one of the key highlights was we spoke about the steps to developing edge, and I'm just going to quickly go over those steps again, just refresh your mind. So those steps, first and foremost, was we want to recognize the pattern. So you have a profile or you have something that you've identified, you recognize a pattern that tends to play out more often than not. And we said that was step one. We then said once you recognize a pattern, something that makes sense to you, something that you're familiar with, and something you're observing quite often, we said you want to go and do a good old-fashioned Harry hindsight on that setup. So you want to take that type of pattern and go and look back in time. Go and try and find that pattern, as many observations of that pattern as you can find. Once you've done that, what you then want to go and do is you also then want to go do what we like to call a replay functionality. And all that is you try and find some form of recordings of how that pattern played out, so that you can define all the key characteristics of that pattern. You can do as many observations about that pattern. Once we've done that, you want to then go and set the conditions for the pattern. So you want to identify all the parameters and the conditions for that pattern, whether that means what time of day the pattern occurs to, or when it works best, what day of the week it works best, high volume or low volume conditions, out of hours or cash hours. All these sorts of conditions you want to identify about the pattern. You then want to go and set the rules for the pattern. So you want to outline the very parameters that will make this pattern successful. So create the rules. Where do you buy it? How do you execute? How many the prices are you looking for? How are you going to manage your risk? What sort of size are you going to be utilizing on this trade? When are you going to be taking this trade on? And then you want to go and test it. Okay, you want to use small size, test it with as smaller size as possible, and have a look what the results spit out, because it's the results ultimately that will determine whether or not we can scale up on this particular pattern. And then last but not least, number 7, we want to assess and upgrade. So important, guys. Right, too many people stop at step number 6. They start making money, they realize it works, and they stop sort of advancing the setup and enhancing the setup. And as a result, eventually the setup starts to work maybe not as well, the probability of success starts to disappear a little bit, and then we just give up on the setup. And that's why you need to constantly be looking, how can you take this setup and constantly improve it so that the edge continues with that pattern. So that's what we spoke about with regards to the steps to developing edge as a trader. All right, we then went on and we spoke about the principle of objective versus subjective analysis, and I spent a bit of time on this for good reason, guys. You need to make sure that you understand this, because this, for me, is probably one of the most crucial principles that you need to learn as a trader. And very simply, we said that objective is very much fact-based, sort of type analysis. It's unbiased, it's unemotional. And we then said, if you go look at subjective, sorry, this should say subjective. So we have subjective there. So, and we said subjective is very much opinionated, and it's got a bias toward it, and it's feeling and intuition and all these ideas. I like to think of subjective as almost like ideas that we have in our head. And the crux of it, what we got to, we went through some really good examples. And what I want to get to is the crux, is this idea of the balance, okay? You need to find this happy balance between objectivity and subjectivity. Yes, it's good to have ideas. Yes, you need to, come in with all sorts of ideas as to, the fundamentals and the technical backdrop, and this could potentially happen and that could potentially happen. But in order to initiate on those ideas, you've got to have objectivity. If you do not have the objectivity, you haven't got edge. All you've got is an opinion, a bias, a hopefulness. Right? That's not good enough, guys. If you want to, make sure that you develop your edge and really succeed as at this job, you have to ensure you get the happy balance between subjective and objective. Alright, guys, that is where we got to in part 1. So now that we've done summarizing part 1, it's time for you to go and test yourself on the principles we've discussed and complete the summary checker. Good luck.
Excellent. Congratulations on completing part 1 of module 1. It's now time for me to check that you understand the principles we've dealt with in part 1. So answer the following questions. What will you do to be a part of the 5% who succeed at trading? Why do professional traders use volume profiling? What are the steps to recognizing and implementing a new pattern using volume profile? And what is the difference and importance between subjective and objective analysis? Make sure you answer these questions first, and then next up we're going to practically apply the principles from part 1. It's time to put those theoretical principles into practice. Welcome to your trading playbook. The purpose of this playbook is very simple. It's a summarized version of the key principles you've learnt in part 1. Make sure you keep it up to date. Answer the following questions in the playbook provided. Complete your trading mission statement. In order to do this, answer the following questions. Why do you want to be a trader? What do you want to achieve from trading? What timeline are you giving yourself to achieve success in trading? What does success mean to you? What are your goals with this course? Then, complete the steps to developing an edge in your virtual playbook. And the last question, have a look at the Euro-Dollar FX daily chart provided. Write down all the objective fact-based points in the left column and subjective opinion-based points in the right column. Good luck, and see you in part 2.